What's up everybody, Nate here, and the entire world economy right now is on the brink of collapse. The UK and China have decided to turn the money printer back on in order to get themselves out of an imminent bond market crisis. Not only that, but we have the United States Federal Reserve raising interest rates very aggressively and very quickly, which could cause a complete economic slowdown here in the United States. Meanwhile, we have inflation all across the globe and thousands of businesses that are about to go bankrupt and close their doors. So today, I kind of want to talk about how the UK bond crisis, the China real estate and economic collapse, and the United States Federal Reserve is kind of creating the perfect storm for one of the largest global collapses in our planet's economic history. All right, so I want to start with the UK here. Now, over the last few weeks to the last couple of months, the UK pound, which is basically their dollar, has been decreasing in value compared to the United States dollar. The reason for this is because the UK is facing inflation that is basically unprecedented. Their inflation is arguably a lot higher than ours, so investors and people in the country are starting to turn away from the British pound. Now, while all of that is happening, the UK got a brand new prime minister, and she plans on instituting some pretty serious tax cuts and borrowing a whole lot of money and spending a whole lot of pounds in order to get themselves out of an economic crisis. Well, investors didn't really like this either because that is inherently inflationary. So that is just going to make the value of the pound go down even more. So they started to sell off a lot of their bonds. Now it's basically twofold. You have the pound going down because of really high inflation, and then the United Kingdom government wants to institute more inflationary policies, which pushes investors away from bonds, and that means a lot less government spending, a whole lot more borrowing. And it means that all of the funds that hold these bonds within them are going to start losing a lot of value. All liability investment funds in the UK have a lot of these government bonds, so with the pound going down and all of these investors starting to sell off these bonds, now the value of these funds started to lose all of its money. And these funds actually help to support a lot of the pensions across the UK, meaning that millions of people are starting to lose their retirement savings. In order to compensate, a lot of the fund managers actually started to sell even more bonds. That way they had money to actually support the entire pensions and all of the rest of their investments within the fund. As more and more investors dumped these bonds, that basically just accelerated the entire process with the value of them going down. Now at this point, the Bank of England has decided to step in and turn the money printer back on in a quantitative easing program. They're going to start purchasing billions of dollars worth of bonds for the next 2 or 3 weeks in order to keep the entire market afloat. They want to try to save these pensions, and they want to try to stop people from selling more bonds in the future. This is all at a time though when the Bank of England literally just last week decided to raise its interest rates higher than it pretty much ever has. So basically in England right now, you have monetary policy that's fighting itself. You have these inflationary policies with lots of borrowing and spending and the pound actually decreasing in value. And you have the complete opposite side. The bank is trying to raise interest rates in order to stop inflation, but they're kind of just hurting the economy while raising inflation all at the same time. Immediately what this does here in the United States and for our currency, it strengthens the dollar because now more people are starting to invest in the dollar. They're starting to invest in American companies, and that means that our dollar is a whole lot stronger. What it really means is that businesses are now going to see less profit because a really strong dollar means a lot less spending. That means there's a lot less inflation, and that means that these businesses on the New York Stock Exchange or just in the United States in general are going to have a lot smaller of profits, and we'll get into all of that in just a second. I want to switch gears now and talk about China. Now, China has been going through an absolute real estate crash over the last few months. Actually decided that they were going to slow down their government spending, and this led to their own bond market crash because now investors are starting to turn away from its currency. Not only that, but the country is not bringing in enough revenue right now to support taxes. So the first thing that China has done is started to cut taxes, which again is highly inflationary. Now you're going to have a lot of businesses and a lot of citizens of China that are going to start spending a lot more money. Meanwhile, the government of China is trying to fill the void by stimulating the economy, by printing more money and by borrowing even more. There's a large portion of people in China that are not paying their mortgages right now, and on top of that, a lot of businesses have been hit by the entire worldwide economic slowdown. Manufacturing is huge in China, but in the United States, there's not as big big of a demand for a lot of their products right now because people don't have as much money to spend and our own inflationary pressures. So that means those businesses are no longer getting the capital that they need in order to survive. China has turned around and turned on the money printer in order to fill the void and stimulate the economy once again, but that is highly inflationary, turning investors away from their currency. Now they are starting to do the exact same thing, except for instead of quantitative easing, they're starting to just pour money back into the economy in order to stimulate it. In fact, China has now approved more stimulus measures and more money printing than they did all the way back during the height of the pandemic in 2020. And of course, now how exactly does all of this affect the United States and our own money? Well, the Federal Reserve here at home is doing the opposite of both of those two countries. So the Federal Reserve here at home is raising interest rates. They want to restrict the economy as much as possible so that way there's less spending and businesses don't make as much money and, well, they're just not going to be able to keep as many people and that leads to unemployment. And in the Federal Reserve's eyes, that's kind of a good thing because now you have a whole lot less spending. Right on the surface though, nothing has really happened even though the Federal Reserve has raised their interest rates really high. We haven't really seen a whole lot of unemployment. In fact, there are more people employed today than even before the pandemic. So we have unemployment that is at a historic low. Fewer and fewer people are filing for jobless claims, whether that's a new claim or a continuing claim. So that means that our jobs market and our economy is still really strong. People are still going out and spending money, albeit it's not as much as they were spending in 2021 because inflation is so high right now and the prices for groceries and energy and everything else are going way up, but people still are spending. In fact, they're spending pretty normally. Couple that with the amount of debt that has risen over the last couple of years, whether it be from the housing market, the auto market, or the credit card market. Now you have a situation where people are spending all of this money, but there is a slow economic cloud building over our country right now. With the Federal Reserve raising interest rates, like I mentioned before, that means that investors are not going to be pouring as much capital and liquidity into these companies. They're not going to be able to grow as fast, which means they're not going to be able to pay all of their current employees. And this is a designed plan from the Federal Reserve because they want unemployment to go up at least a little bit, so that way that forces people to not spend as much money. But people still have a lot of bills to pay, and with debt hitting an all-time high, this is a serious problem because all of that debt has to be paid by somebody. And if Americans don't have a job anymore, well, then now it falls on the banks and it falls onto the investors. With the UK actually making the dollar even stronger, now businesses that do want to grow even a little bit are going to have a much harder time doing so because every time the dollar gets stronger, that means businesses in the United States get a lot less profits. And right now we are slowly starting to see this bleed into other things in the United States, like the stock market has been slowly crashing and it's actually erased all of its gains that it's brought in over the last 2 years. That means even less liquidity, a lot less investor interest, and ultimately that means a whole lot less jobs in the United States. The housing market is starting to slow down, same with commodities and cryptocurrency. And as all of these markets start to slow down in the United States, that means everything is going to slow down. Businesses and of course, money. All of this compounds on one another, and we're not really sure what's going to happen next with our economy because there's nothing saying that a bond market crisis can't happen here in the United States. The fact of the matter is it absolutely can, because as inflation continues to go up, depending on what the Federal Reserve does, that is either going to make the bond market stronger or a whole lot weaker, and this directly correlates with government spending. But we have a similar trend going on in the US with a whole slew of tax cuts coming out from the White House, and we don't know what's going to happen with the Federal Reserve. Right now, the Federal Reserve wants to get inflation down to 2%. It's right around 8.3% as of today, so they have a very long way to go, but they are set on getting inflation down, and that could take 2 years, that could take 3 years. Nobody really knows how long it's going to take, and in the meantime, inflation continues to go up, prices continue to go up, while wages are not meeting them, which means people don't have as much money, and businesses don't have as much money either. Let's say the Federal Reserve decides to flip the switch when we hit inflation of around 5%. They may say that's good enough, and they might start stimulating the economy once again. That means we're going to have a lot of tax cuts, a lot less revenue for the United States government, and now they're turning the money printer back on, and that could immediately start devaluing the dollar once again, and that could have a snowball and a domino domino effect to every other world nation, because we are the reserve currency of the world. The United States dollar is the reserve currency. So all of these other countries hold US dollars. They're going to have to dump them very fast if the US dollar is no longer stable and is highly inflationary. But if none of that happens, the Federal Reserve has admitted that them raising interest rates is still going to cause a lot of pain, because there's going to be a lot more unemployment, and there's going to be millions of Americans that can't afford a lot of things for a very long time until they can bring inflation down to that target range. And all of this is kind of combining together to create a perfect storm, the likes of which we have never seen before. Now, to be completely honest with you, I don't know exactly what is going to be coming next, because there's a lot of moving parts between other countries and different markets, and a lot of money that is flowing in and out right now. Nobody really knows what's happening next, but what you need to do in this situation is to keep yourself up to date with everything happening in the business and financial world, and to try to stay as financially educated as possible. No matter what happens, you want to try to stay on top of everything. So you want to know what to do with your money. You want to know how to invest your money. That will keep you protected and your money protected no matter what actually ends up happening. What this is all leading to is a lot less money circulating throughout the country, and inflation pretty much staying high for a very, very long time. And with China and the UK essentially turning back on the money printer, it sets a dangerous precedent for every other country in the world to essentially do the exact same. That's why investors in pretty much every market are getting out right now, because as the dominoes start falling, there's a lot of uncertainty, and they don't really know where the dominoes are going to end up. But now I want to hear from you on this issue. What do you think about our global economy right now? Do you think it's going in the right direction, or do you think it's starting to go in the wrong direction? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.